Hello, everybody. This is Dr. Richard Smith, and we are wrapping up the 80th anniversary celebration for the Foundation for the Study of Cycles. It's been an incredible week, starting with our Science Cycles Summit for 7 hours on Saturday, led by Ray Tomes. If you haven't seen some of that material, it's available free on YouTube. And then all this week, our Financial Cycles Summit, where we heard from Robert Prechter, Tom DeMark, Rob Hoffman, and Larry McMillan. I don't know about you, but I sure feel like I've been drinking from the fire hose. And that is why I am so pleased to have today's guest, Jack Schwager, with us to talk about really the bigger picture of this arena of speculation and market involvement, because it can be pretty overwhelming. And Jack, for those of you, I don't think he really needs an introduction to this audience, but of course, he's the author of the Market Wizards books, series of books, Market Wizards, New Market Wizards, Stock Market Wizards, Hedge Fund Market Wizards, and now Unknown Market Wizards. So Jack, we're thrilled to have you. Welcome, and looking forward to the conversation.
And likewise.
So one of the things that surprised me as I was doing research for this interview is actually how much of a background as a professional you have in financial services. So, I knew you, of course, from your Market Wizards books, but and I sort of thought that you were a journalist and a writer, but it turns out that you actually came into this through economics and financial services. So would you just share with our audience a little bit of that background and history that kind of teed you up for ultimately launching Market Wizards?
Yeah, thanks. Yeah, so I started out as an analyst, and I'm sort of an analyst who became a writer. I didn't have a vision of being a writer. It sort of happened. And it's one of the things I always stress not about trading so much, but about life, is that just how incredible if you really think about your life, all the key things in your life, at least in my life, just by chance, So my profession, my marriage, everything is just by the most crazy chance thing. So
yeah,
Market Wizards, the series of books would never have been. I probably would never have even ended up involved in markets if I didn't, after coming out of graduate school, get impatient with the employment search service, because I figured coming out of Brown, with an economics degree, I should have a job tomorrow. And 2 weeks, and they weren't calling. I wasn't getting calls back. I didn't have, they just basically are not good to work with. At least they weren't at the time. Anyway, so I just put my own ad into the New York Times. At the time, I don't think it still exists, but you could put in a position wanted ad. And I just basically put in the cheapest ad I could put in. It was a minimum of like 2 sentences or something. Cost, I think, like $15. And basically the ad said something like, graduate degree in, in economics, minor in math, and looking for an analytical job. Yeah, that was basically it. I got about 15 calls. 40 of them were scams. I fell for one, which is too long of a tangent. I mean, when I say I fell for it, is I showed up. And I said, God, this is a scam. But it's a long story. I won't go into it, but it's a funny story. I always thought I should have written it up because it was such a bizarre thing. But once I saw one, I knew what the game was. But I had one legitimate call, and the legitimate call was for a research analyst job. It just so happened that Michael Marcus, who ended up being chapter 1 of the first Market Wizards book, was leaving to, quote, become a trader, and unquote. And so the research director was going through the Times, spotted this ad, gave me a call. And so that's how I got my interview for that job. I eventually got the job by writing. I wrote my way into the job, actually.
So you took Michael Marcus's job?
I took Michael Marcus's.
Oh my goodness.
Yeah. Yeah, so that's
another
serendipitous.
Part.
That's another part of the random thing, right?
Right.
I mean, the whole thing that I had no intention of going into finance at all. I was not involved in markets. I didn't have any interest in trading. I really knew not, and I had no knowledge at all.
Mm-hmm.
So that was just by chance. And he, the research director, a fellow by the name of Erwin Schisko, at the time wrote a column for Barron's called Commodities Corner. And since he was interviewing, different people, the way he made the choice was he'd get it down to 4 candidates, and he gave each of us a market to write up. So I got copper as my market. And this is back in the days, we're way pre-internet here. Mm-hmm. And so I spent a week in the Grand Army Plaza Library, which is in Brooklyn, New York. And I just read, they had like daily market week bulletins on metals, and there was a Metals Weekly from McGraw-Hill, I think. And there were some books I found, but I basically read everything I could on copper. And I just wrote it, so having no prior experience, and based on 1 week of research, I wrote an article on copper. Mm-hmm. And that basically got me the job, I was told later they passed around the office, and they passed around all the articles, and they said, hey, hire this guy. So that ended up, but it was just that. Now, had Marcus quit a week or earlier or later, had his boss not looked in the Times, had I not put the ad in that particular week, it's all random chance. So that's how I ended up in markets. And after having been in it for a little over a decade, maybe 12 years or so, I basically felt it wasn't a good textbook. So I said, I thought I would write my own. And I took a sabbatical, and I wrote a book called The Complete Guide to the Futures Markets. And that got me involved in writing. And that ultimately led to my writing Market Wizards, because I had another publisher approach me later and wanted me to do a whole bunch of analytical books. And I said, did that once, no interest in doing that again. And I joked that and I was trying to just do the best book. I wasn't trying to make it overly quant, but I just, put in, I had a whole section of regression analysis. You can't do regression analysis without equations. And I semi-facetiously would say that the sales of a book are inversely proportional to the number of equations in the book. So I knew including that section would reduce the sales of the book. And I'm sure it did, because it was like I was going to write a chapter, and it ended up being like 6 chapters, because when I started writing the first chapter, I said, hey, I can't assume anybody knows this. I had to write a book, I had to write a chapter on basic statistics, then I had to write a simple regression and multiple regression and so on. So, that's how I got involved in writing.
And you went on to be a research director at
after a couple of years. Yeah.
And you met a lot of these people that you ultimately ended
up
interviewing.
I knew Marcus.
Market Wizards.
Yeah, I met Marcus actually when I was taking my job. He was cleaning out his desk and I was coming in. He was in New York for a couple of years. We got together for lunches, every couple of weeks. So I had that. And Marcus, of course, hired Bruce Kovner. So I knew Kovner through Marcus. Mm-hmm. And I think I'm trying to remember who else I knew before I started the book. But those were 2 of the key people that I knew. And I figured, well, I've got a couple of real great traders, and I'd go from there.
So have you ever thought that taking of that job was fate, or do you think it's chance and it's making the best of chance?
Yeah, so that's my philosophy in life is it's some combination. I'm not sure what the percentage mix is, but it's some combination of chance and what you make of it, So
being prepared.
And so I will never think that, hey, I'm something hot stuff because I've been successful, because I recognize that it could very easily have been very different. Had I not gotten that job, who knows what I would have ended up doing, right? So I think a lot, but, I did get the job. I got it because, I took the getting the job very seriously. Like I say, spending an entire week in the library, just really, working hard on to get it. So I had that luck, but I also made use of it. Yeah. And I find that theme comes up when I interview traders repeatedly. There are instances where there is luck, but they take advantage of the luck.
I don't know where I heard it, but I've heard the phrase ROI on luck. Maybe it was from the Good to Great guy, right? He lives near you in Colorado, I think. What's his name? Not Peter Drucker, but the other big guy who was a Peter Drucker protege.
Yeah, I don't know.
Who wrote Good to Great. It'll come back to me in a minute, but he talks about ROI, on luck, right? How do you make the most out of the luck that comes your way? And I think that does have a lot to do with successful speculation as well.
Yeah.
So what I'm really interested in focusing on in this conversation, the foundation for the study of cycles, a big part of its legacy is really a communication with the public. We're not quite the Farmer's Almanac, but there is this element of, research and discovery about cycles, and then also sharing that knowledge and information with the public and having a public membership. And so communicating with the public is a big part of the legacy of the foundation. And certainly communicating with the public is a big part of your life. I mean, I can't think of too many people on the planet right now who have more people who are interested in the markets have read their book than you. So what can the public really take away from the wisdom that you've collected in the Market Wizard books? I'm not talking about people who are going to be professional traders, right? I'm talking about, say, the people who have TD Ameritrade accounts, or now, the people who have Robinhood accounts. I don't know how many of them are. I mean, there's over 10 million now, I believe. So what would you want, those people to learn from what you've learned?
It's hard to answer that question without being sounding self-promotional, but
no, that's fine.
Yeah, and I'm, and I consider myself basically a straight person and so forth. So I would say this if it was somebody else's books.
Yeah.
And I can also say it because it influenced my own trading. So I honestly believe that if you go through the Market Wizard books, any of them or all of them, and you really pay attention to, basically I'm a conduit for what these traders are saying. Although I do also give my own opinions, but they're clearly delineated. But I think if you go through those books and you really, read it carefully and pay attention and take what resonates for you, almost hard not to get better. Okay, so I make it clear, look, only a very small percentage of people will ever be market wizards. But I think a large percentage of people can become better traders if they take the lessons that are explicit and implicit in those books, because they're timeless. And there's a reason why many of the traders give the same advice. Because, hey, it's like if you had a math problem, you'd hope that, the different mathematicians would give you the same answer for the solution, right? So it's not quite that, because it's not like one exact answer. But the point is, there are certain truths about trading and markets that are timeless. And it's the reason why a book like Reminiscences of a Stock Operator, which was even ancient when I read it, long time, which was before the first Market Wizards book. But a book talking about bucket shops and all these obsolete things. And my early books talk about trading pits and other obsolete things. So things go obsolete. But that book, and I believe my books as well, there are basic truths in there that just, if you're a trader, you know that when you read it, you can recognize that and
recommend.
And anybody who's had experience trading, and that's why.
So tell us about how to keep a trading journal and why it matters and how it helps.
Yeah. Okay. So because one of the best ways to become a better trader is to learn from your mistakes. You can also learn from what you do right, but learning from what you do wrong is even more important. And the idea is you don't have to, I'm not a stickler. I don't think you have to record every trade. I mean, there's some meaningless trade. I mean, trades that you go in and, they don't mean much one way or the other. But trades where they're truly like you made a mistake, any trade where you made a recognizable mistake.
Right.
And let me emphasize here, mistake doesn't necessarily mean you lost money.
Sure.
Although usually it does, but not always. But a mistake means in fact, I'm going to go on a tangent here for a moment. There's a trader in this new book I know, Market Wizards, and talked about mistakes. And he talks about his worst mistake is he was trying to get back to his high. And so there was a trade and he put on a maximum position. And it was a trade, it wasn't his type of trade really. He just felt that the market's going to go up and all that. And not only did he put on a maximum size position, but he kind of then did two up maximum position. He was working for a prop firm. Mm-hmm. He took maximum position in two highly correlated markets. So he had a 3x position in something that was a 3x maximum position in something that wasn't even much of a trade. And the risk manager came over and he said, "What are you doing?" And it kind of just struck him. And he realized that he was like hoping that this would work. And he got out of everything immediately, which was lucky because it would have been a significant loss. And he sort of learned like never to hope again. But that's an example of a mistake. So he didn't necessarily, or even a better example, there's another trader who, this is maybe the best example of it. So he takes large positions and will normally get out quickly if he's wrong. And this one time, things turned quickly, and he hesitated. And I said, "I can't get out." And then there was a big loss. Mm-hmm. And he was thinking, "I can't get out of this loss." And it came back, so he only lost a small amount and he got out. But he recognized afterwards that not getting out immediately and waiting for that bounce was actually a mistake because there was no guarantee there was going to be a bounce. He was just purely lucky the market bounced and he got out with a small loss. But he recognized that he endangered the existence of his account by not acting more quickly because he had a very large position, which depends on his getting out quickly. And because he had such a large loss right away, he hesitated. And he recognized that even though that hesitation paid off, so it was a good decision in terms of the outcome, but it was a bad decision because if he did that 10 times, one or more of those times, it was going to be Russian roulette. The bullet, the chamber was going to have the bullet. So he recognized that even though it worked out, it was a bad mistake. And so the point is when you're doing a journal and writing, you recognize mistakes, it's not tied to the outcome. It's tied to what the decision was. And so he was smart enough to recognize, even though it paid off, it was a mistake, right? So by putting it down your mistakes, especially, and if you review them periodically, now it won't necessarily mean you'll never do the mistake again. But if you do it, odds are you'll reduce doing that mistake because you'll make the mistake again sometime and you'll, oh God, I had written it down here and I wrote it down here and I'm not doing it again. So it's a way of eliminating mistakes from your trading. And some of the greatest are like Ray Dalio, who has kind of managed more money as a hedge fund manager than any other manager probably ever. Basically, learning from mistakes is his philosophy. I mean, that's what he totally believes in. That's how his whole firm was built, was to continually learn and change the methodology based on learning from prior mistakes. So that's why it's so important, because the best way you can improve is by learning from mistakes. And failure, it's like successful people, this is kind of ironic, successful people realize that failure is a good thing because they learn from failure, they get better from failure. In fact, they become successful because of failure. And the difference between successful people and unsuccessful people is The unsuccessful ones keep on making the same
And you
mistakes,
have to actually have a
hoping
framework
they'll
that
get a
lets
different
you
result.
know whether
And
you
successful
succeeded or
ones
failed
learn
in the
from the
first
mistakes
place.
and change.
I think so many, retail investors are just jumping from one thing to another, and they don't actually have a clear definition of success and failure. Success just seems like something that I made money on, and failure is something that I didn't make money on. But I doubt that's the
Right.
definition of success and failure that Ray Dalio is using.
Yeah, it's not. Although, yeah, it certainly isn't true over the individual trade. Over the long run, though, the bottom line is your equity curve, right? I mean, so um, if it's going in the right direction, you're doing something correctly over time. I mean, sure, there'll be trades there might be bad trades which make money, and good trade, what your performance is kind of, that's one thing about this business. You don't have to wait for a year-end evaluation. You're getting feedback every day.
So can it be as simple as, just getting a notebook, and each time you put on a trade, you make a page for it, you say, hey, I opened this trade, here's what I was thinking, and then you close it out, and then you just write a little retrospective. It doesn't have to be fancy.
Yeah, and in fact, I was just too lazy to keep it up, but on my I have a website which I don't really do much with, and I honestly don't keep it up, just called jackschwager.com. But in there's a trader's log, and when I started it, I put in a number of trades that I had done, my own notes to myself, basically, and that's kind of an example. So if people want to check out an example of what those pages would look like, that's where they are. I mean, so they're a little dated, but you get the idea.
Yeah, I just think it's so valuable for people to understand that, the things that make the biggest difference aren't the particular trades that you make, the system that you're following, right? The books that you're reading, it's things like learning from your mistakes and keeping a journal.
Yeah.
That are ultimately going to be the biggest payoffs for us, and those are, not that expensive. So why do you think people don't do this?
Well, it's easier. It's always easier not to do something, right? It's inertia. So it takes some effort to write it down, and some of the traders in this book, literally, they brought out, remember like one trader bringing out his binders, and like literally binders like this, of like notes
and
past trades.
Wow.
And
So folks, you heard it from the man who has talked to more successful traders than probably anyone on the planet right now. Keep a journal and learn from your mistakes. And, you don't need to learn another system or another Fibonacci level in order to be more successful by just keeping a journal and learning from your mistakes. Are there other big themes, Jack? I know you've mentioned discipline as another big paradigm of successful people.
Yeah, I mean, that's a definite trait. So you really have to be rigorous. Before discipline, you have to have something. Discipline gets applied to two areas, which you have to have, which is a methodology that has some sort of an edge, and a risk management method,
Right.
Which doesn't have to be complicated. It can be very, very simple. But you have to have those two, and that's where the discipline comes. The discipline comes in exercising the methodology and in exercising the risk management. And so theoretically you can come up with a good methodology and good risk management, but if you're not gonna apply it, or you're gonna be tempted to deviate, then it's not gonna work unless you use it, right?
So you need to have a methodology that has an edge.
Yes.
And that fits your personality.
That's another big thing. So, particularly novices come into this business, and they're always looking for, what's the market secret? Whether it's some person selling a newsletter, or somebody selling a book, or somebody with a secret formula for a subscription, whatever.
Yeah.
They think there's some sort of answer to the markets. And
Yeah.
really, it's no single answer. And there's no better demonstration of this that if you go through any books, you'll find people who use both fundamentals and technical.
Mm-hmm.
But you'll find people who are purely fundamental and cynical about technical. And you'll find people who are purely technical and cynical about fundamental. Mm-hmm. And you say, well, how can they both be extremely successful? They are. Mm-hmm. Because it's not the type of methodology. It's for each person. In other words, you can be successful in just using some sort of technical approach, mm-hmm. or using some sort of fundamental approach, but it has to be in line with your beliefs, personality, talents, etc. All of those are important. And it's going to be different for every person. So there is no single methodology. And you're not going to necessarily know what your methodology is right off the bat. And I know in my own life, I've gone through different phases, So I'm now at a point, I'm now comfortable with one type of approach, but which happens to be purely technical and non-systematic. Although I started as purely fundamental, I went through a phase where it's purely systematic. So it was a while before I kind of decided really I'm most comfortable with is purely technical and non-systematic, discretionary.
Mm-hmm.
Discretionary.
Mm-hmm. So, I mean, I know you say it's unique to everyone, right? But aren't there some buckets? Have you seen done any trader typologies?
Buckets in terms of what, methodology?
Buckets in terms of personality types, overall approaches, like, let's say technical with some discretion versus fundamental versus, purely technical and algorithmic. So
there's so many variations that, in this book, because a couple of traders came from the same prop shop, there is some overlap. But other than that, I'd be hard pressed to say I think of traders that I interviewed who were using very similar approaches.
Okay.
It seems like everybody has their own particular spin, their own particular methodology.
So how should somebody who is interested in the markets and who might be getting in, how can they go about figuring out what is the right, a good fit for them? Have you ever taken any, personality tests and?
No. So how do you figure out what books to read? You read books, you read the books on things that interest you, right? Mm-hmm. And what do you end up doing as hobbies or sport or whatever, or different things that you do with your life? Again, there are things that you either like a lot or are very good at, and sometimes the two go together, and which is always helpful. So it's just a matter of figuring out. And so if you're approaching a market, it's a matter of, in the beginning, hey, you come in, you don't know anything, fundamental, technical. I came in coming from a economics type background, mm-hmm. biased to believe that technical analysis was a bunch of mumbo jumbo and only fundamental made sense, right? So I come in with that bias, but ultimately discover, hey, it's not the way it works, at least not for me. But you don't know that in the beginning. It's a matter of trial and error. It's a matter of what you feel comfortable with. For me, actually, one of the big breakthroughs when I started using, when I switched from fundamental to technical, which came early on, after for a few years in the industry. Mm-hmm. But there was a key element to that. I had a fellow work with me who was, so as a research director, I had analysts for all different markets, mm-hmm. and I had one technical analyst. And I started noticing that and hey, this is not a pitch for technical versus fundamental. A lot of people are just great at pure fundamental. But in this particular instance, I found that the only analyst I had working for me who was really, I wouldn't say consistently right, but definitely more right than wrong, and whose advice was worth listening to, was the technical analyst. Mm-hmm. So, and who shared an office, who I became very good friends with, a fellow by the name of Stephen Kronowitz. And I finally asked him, to explain what he was doing. And I finally got from him that a rationale, which was that reason why it works is because bottom line, prices, reflect everything. So any news that comes out, any people, no matter where you're putting the orders in, no matter how you try to hide what you're trading, everything is reflected in the price. So it is not really a wild assumption to say, hey, if everything that is going into the market is impacting this indicator, namely price,
right,
that there is information there. So that made it rational. I needed a rational explanation. It couldn't be, here's a head and shoulders thing, and then, it's going to go. Why should head and shoulders go up or down or whatever? But it's understanding that the rationale, that price reflects every input into the market. And then the other big thing, which is related, and again, I'm not pitching technical analysis, I'm just saying for myself. For me, the big thing was when I was using fundamental analysis, I had no fundamental analysis, and many times almost fights risk management. Because if market X is a good buy at 50 and nothing changes and it goes to 45, it's an even better buy. Right. And so the logic of it is the more position goes against you, the more you should put on, which is the antithesis of good money management. Whereas in technical analysis, basically, whatever approach you're using, even if it's counter trend, definitely if it's trend, if it's trend, you put it on, and if it starts going the other way, you should be out because your approach is telling you that, it's not working, the trend is broken or whatever. But even on a counter trend trade, if you're doing counter trend properly with risk management, you said, okay, I'm expecting the market to fail here. I know you're like, you use cycle analysis. It could be because, let's say, a number of cycles are topping in this particular zone. So you expected the top in this particular area or this particular time, maybe a better way of putting it in that case. Or if you're using more traditional technical analysis, chart analysis, you maybe have a concentration of highs and lows at a spot. You've got 50% retracement on a long term. Yep. You got a 61.8% on a shorter term retracement. You got a number of things all concentrating in the zone. Say, okay, here's a reasonable spot. Maybe you got some market swings that are coming. So often if I'll do a counter trend trade, there'll be multiple reasons why things are seemingly concentrated in one particular time price zone. Yeah. So you put on, let's say you're selling into a rally, but if it goes beyond that zone by some defined amount, you say, okay, I was wrong. Or even if it wasn't wrong, I'm not going to risk beyond that point. Yeah. So technical analysis it lends itself to risk management, whereas fundamental analysis is difficult. It's difficult to employ. You need to, but it's difficult.
All right, so that leads me to risk management, and a quote that I read from you in another article said, "The closest thing to a single common denominator is that almost all of them are pretty rigorous about risk management."
That sounds exactly like something I would say.
So, how do people manage risk when they don't have, a prop shop behind them?
Yeah, so this is kind of the ironic thing. You've had entire books written on risk management. You've had multi-volumes even written on risk management. You have hedge funds which have multiple quants, for risk management. But bottom line, the essence of risk management, I could put on one page, and I could probably get 90% of the way there with one sentence.
Let's do it.
And and the one sentence I like to quote is from Bruce Covenor, who said, and I like to say that if I could only give one sentence of advice to people, it would be this sentence. Okay. And the sentence is, know where you will get out before you get in. And basically, if you do that, if on every position, okay, I'm going to sell here, I'm going to buy here, but at the same time you put the order in, you put a good till cancel stop, predefined, and you basically, of course, markets can gap on, if you have an earnings report or whatever, you can gap, but generally speaking, in most cases, you'll get close to the stop. So you're pretty much, for large, overwhelming percentage of trades, you're defining approximate risk for every trade you put on. And if you do that, so you're not risking more than some defined fraction in each trade, and that defined fraction should be, in my mind, probably a fraction of 1%. So it's less than what people think.
For every trade. Less than 1%. Any trade.
Less than 1%, yeah. And some of them more very, somebody like Peter Brandt, who's the first chapter of Unknown Market Wizards, I think his average risk per trade is something like 30 basis points. That's what he risks on any given trade. Mm-hmm. So the point is, no given trade is going to do any real damage. And you want to make the probability of risk of ruin as low as possible. Mm-hmm. And the higher your bet per trade, the greater that is. So anyway, if you don't bet too much on any given trade, you have a stop in when you put on a trade, you basically are not going to get damage on it. And like I say, that one sentence really, literally, will get you 90% of risk management. Yep. I mean, you can read, like I say, you can read volumes of books on risk management, and you'll only get to add 10% to that sentence.
And the sentence is where to get out before you get in.
Get in. Yeah, by know I mean actually make sure that it's true. So yeah. In my case, whenever I put on a trade, I will put in I'll put in a stop along with the trade. Yeah. Assuming it's a straight outright trade.
I completely agree. That is the most valuable sentence that has been spoken all week in the Financial Cycle Summit. Doesn't matter if Robert Prechter has convinced us that 233 years of history are culminating in 2021 and the end is nigh. It's still much more important to know where to get out before you get in. And really, that's where my career started as well, which was with trailing stop losses in 2005 when they weren't that available in the brokers. And I set up this service to help people track trailing stops on their stocks. And then eventually, why that's so important is because I connected it to Kahneman and Tversky, right, and prospect theory. 2 Nobel Prizes in economics now, Daniel Kahneman and then Richard Thaler, that point out the fact that we hate to lose. And that when we're losing, the fact that we hate to lose makes us not want to sell. So we take on more risk. We become risk-seeking when we're losing, right? But when we're winning, the fact that we hate to lose attaches itself to our profits, and we tighten up. We become risk-averse with our profits, right? So Kahneman literally got the Nobel Prize for saying we're risk-seeking when we're losing, and we're risk-averse when we're winning. So if you don't know where you're going to get out before you get in, you will succumb to this loss aversion, right? And you will be risk-seeking with your losers, and you will be risk-averse with your winners. And to me, that's the most important evolution in the life of a successful speculator, is being able to be risk-averse with your losers and risk-seeking with your winners.
And that's because if you're in the position, you have no objectivity, because you fall prey to these natural human instincts of doing the wrong thing, which is basically giving it more room on a losing trade and snatching the first quick profit so you doesn't disappear on a winning trade, never getting a big profit. So if you don't make the decision before you put on a trade, then you're going to be subject to emotions. Whereas before you put on a trade, you have this tremendous advantage of objectivity, because if you're not in the trade, you're not subject to those human foibles, as Kahneman and Tversky point out. Yeah. Because you're not in it. You don't have anything at stake. So you can make those decisions rationally, but you lose that rationality, and people are not rational, which is the whole point of behavioral economics. Yeah. People are not rational, and that's been demonstrated in a million different ways. Yeah. But if you don't have a position, you can be rational.
So I've got your latest book here, Unknown Market Wizards. Great book. I recommend it to everyone. Particularly inspiring, I think, for those of us who believe that we can be successful in the markets, because these are stories about people that aren't part of big hedge funds, aren't at prop firms. They're just individuals out there who have demonstrated success in the markets. And in the back of the book, though, you have some risk management metrics, So you
Oh, yeah.
cover the Sharpe ratio and the Sortino ratio and the gain to pain ratio. So I know, as you said, the more formulas you have in a book, the less books you'll sell, and it's probably the same for, a live stream. But I think it's really significant that you thought it necessary to put these primers in your book to explain to people what is Sharpe ratio, Sortino, and gain to pain. So I just want to talk about them for a few minutes on the
Sure.
risk management side, because I think that might be the other 10% beyond, know when to get out before you get in. So can you just share with our audience, why those are important, maybe a little bit about what they are in layman's terms?
Sure.
And
So basically, my overall philosophy is that people pay much too much attention to return, where what you really should be looking at is return to risk. And I can prove that to you, to the listeners, very easily, okay? So everybody listening out there, I'm going to tell you now how to make twice as much money on your trading. Just double your positions on every trade. Okay, now, does that make you a better trader? No, of course not, because you're going to lose twice as much in your losing trades, and your risk is going to, double. And so clearly, that example should make it clear that return alone is not a metric, because you can improve by just risking more money. So you need to normalize the return by some sort of risk measure. Now, the way the investment community basically does it, for the most part, is through the Sharpe ratio, where the normalization, the denominator to the return, is a volatility measure. And the premise is, the more volatility, the more risk. Now, that is true some of the time. It might be true most of the time, but it's actually false in quite a number of cases. So it's not a very good measure. And look at it this way: if you invest money and somebody loses 20% in a month at manager, well, that's volatility, and you're going to think this is horrible. And yeah, that seems like risk. But how about a manager who makes 20% in a month? Are you going to call up and complain, why'd you make 20% a month? You're so volatile. Nobody. I don't think there's an investment history who's ever complained because of a large upside move. Mm-hmm. So volatility doesn't really reflect people's intuitive sense of what risk is. What risk is loss. It is not volatility. Mm. And there are many traders, particularly in the books I write, mm-hmm. and in this latest book as well. In fact, this latest book is kind of almost a poster child for people who have high volatility, but yet moderate risk. Mm-hmm. So you have traders here who have enormous gains, but very few large losses. Mm. So it's kind of not only unfair, but it doesn't make sense to say they're highly risky, because you're saying they're highly risky because they have all these months where they're making big profits. But right. If they don't have months where they have big losses, that doesn't really make sense. And it doesn't make sense because there are trading methodologies that are very asymmetric. They are based on finding situations where there's a big profit potential, but the risk to get that profit is not large. Mm-hmm. So clearly volatility is not a good measure. Why, by the way, why is it used? And Richard, I'm sure you could appreciate, you obviously know the answer and will appreciate my answer, which is simply, it's used because mathematically it's you can define, it's quantifiable, and it works out very nicely. You get all sorts of you can use a normal distribution curve, therefore you can make predictions about risk, and it has many ramifications
because the economists have physics in
really convenient. So to me, it's more like the old cliche about the drunk looking for his car keys under the lamppost because that's the spot where there's light, and not necessarily the spot he thinks he dropped the keys, right? So it's kind of an analogous to that.
I think I can just add a little bit of color here.
Sure.
So the Sharpe ratio is literally, the amount of money, you make. Is it on a daily basis, kind of your average daily gain?
The Sharpe ratio could be on any, typically it's annualized.
Okay. And then divided by the average, up and down move in your portfolio.
The
so
annualized
the reward divided by the risk, right?
by the annualized volatility. Yeah.
Minus, of course, a little, risk-free return up in the numerator.
Which
But
is
what you're
not
saying is that because in the Sharpe ratio, you kind of get penalized for up moves as well as
Yes.
down moves in the denominator, right?
Exactly.
And so the Sortino ratio tries to reduce that by only measuring the adjusted Sortino ratio.
Yeah, eliminate it. So what the Sortino does says it will take the deviations only on the downside.
Right.
So it throws out all the points where there's upside deviation, but it's only focusing on the downside deviation. So large downside deviations penalize it. Large upside deviations aren't used in the calculation.
So you talked about Peter Brandt, for example, and he didn't have that great a Sharpe ratio, but he had a fantastic Sortino ratio.
Is better.
He really didn't have, like, his downside volatility, his losses volatility were very controlled.
Right.
So,
But yes, and Brandt is true. It's true of Brandt, but there are traders in the book like Arit whose the ratio between the Sortino measured correctly, which I'll get to in a moment, because people don't measure it correctly. The Sortino ratio measured correctly versus the Sharpe ratio, for most traders, they would be about equal. But for Arit, I think his Sortino is about 15 times as high. I mean, it's extraordinary. I don't think I've ever seen anybody with more than a 2 or 3. Yeah. But he has so many huge gains and so few, and almost no large losses.
Wow.
Then in his case, it's like the ratio is absolutely crazy. Literally something like 15 to 1.
Let's come back to him in a minute.
What's that?
I said, let's come back to him in a minute.
Yeah. So anyway, so now so on Sortino, so you're only looking at the downside, the losses, not on the gains.
Right.
And because I think this type of audience, there are people which are a little bit technical and will appreciate this. And because as far as I can tell, I think everybody or most people or most services are calculating the Sortino wrong. When I say they're calculating it wrong, means that they still they define N, in the calculation, there's a number of observations, and they define N as all observations. Well, if you think about it, roughly speaking, in the Sortino, you're only using the losing observations, not the winning. So if it was a normal distribution, you'd be throwing away exactly half the points. And that's a reasonable starting point. So essentially, you're only using half the distribution. And yet people they don't use N over 2, they use N. And it works out in the calculation. It becomes, so what you really need to do is divide by the square root of 2, which I think I have the explanation in the book.
Is that what you call the adjusted Sortino?
In the appendix. What's that?
Is that the adjusted Sortino?
Yeah, adjusted Sortino, right.
Okay.
So we calculate the Sortino dividing by the square root of 2, and when you do that, then you can compare Sortinos to Sharpes. And the significance of that is if the Sortino is significantly higher than a Sharpe, it's the adjusted Sortino, the way we calculate it, is higher than the Sharpe. Then it tells you that the trader is right skewed. It must be large. His tails on the winning side are bigger. His more big wins than big losses. If it's the other way around, that the Sharpe is higher than the adjusted Sortino, it's telling you that the big losses are bigger than the big gains. And so it's very useful. That's why it's useful to use the adjusted Sortino. If you use the regular Sortino, the way people calculate it, you can get traders who have a higher Sortino. It's biased to give you a higher Sortino. And then people mistakenly interpret that to mean that the trader is right skewed, which in many cases is not the case. It's because they're not calculating it correctly.
Okay. And what about the gain to pain ratio?
So the gain to pain is my own kind of, I guess it's that and the Sortino are my favorite ratios. The gain to pain is very simple, but very powerful. Ideally, you apply it to daily data, but you can apply it to any time, monthly data, whatever. So let's say we're taking simple, people used to using monthly data. You take all the monthly returns, you sum them. Then you take all the monthly losses only, and take the absolute value and you divide the sum of all the returns, which are gains and losses, divided by just the sum of the losses. That's the gain to pain ratio. What it's basically telling you is how much money, the ratio of the money you made to the money you lost to get that amount. So if you have a gain to pain of let's say 1, it means,
and it's not using volatility, it's using actual losses.
Actual losses, and it uses every loss, and particularly we like to apply it on daily return, like in our side front seater uses daily return. So, which is particularly meaningful because that means that every time you have a daily loss, it shows up. So you can have months where maybe a trader only loses 2%, but intra-month he was down 20 and he came back. It's only by chance where the month ends. If the month had ended at a different spot, it could have been down 18%. But the great thing about using daily data is there's no place to hide. So anytime you have a loss, it shows up. So you're basically penalizing the ratio by every loss that occurred. And of course, the larger the loss, the more. And so anyway, I find it very useful.
So no matter what you're doing out there, folks, if you're using cycles or not, if you're listening to Tom DeMark or Robert Prechter or anybody else, know where you're gonna get out before you get in, and have some way of looking at your reward versus risk, where volatility can be a proxy for risk. I do a lot of that, but really understanding risk as loss, which I think is a really important point. Add those two things to whatever you're doing, and it's going to get a lot better. Wouldn't you agree?
Yeah, that's what I'm basically saying.
Yeah. So let's talk about this wunderkind that you uncovered through Fund Seeder and profiled in Unknown Market Wizards with the big rights.
Okay, so
what's he doing?
Well, actually, in Market Wizards, Unknown Market Wizards, I found traders in 3 ways. 1, I knew a few of the traders. 2, a few of the traders came off of the Fund Seeder site. And 3, I put out several tweets when I was getting ready to do the book saying, if you are a market wizard, and I gave some definitions, or know one, and would like to be interviewed for potential inclusion, let me know. And I got hundreds of answers.
Okay.
And I think we're talking about Arit here, and he came from that particular group. Somebody had actually Steve Goldstein, who's a trading coach in London and coaches some very successful traders. He was actually the source for two of the traders who ended up in the book, and Arit was one of them.
And how does Arit?
So what does he do? So Arit, basically, he's sort of a combination of super preparedness and knowledge on how fundamental events impact markets, and intense preparation for each trade in a mental framework. So for one thing, Amit's one of these guys who keeps a journal of everything he's done. He's researched everything. He'll trade events like central bank announcements, stuff like that. He will have researched, the past history. He will know how the markets react in every case.
Sounds like Ray Dalio.
Yeah. Well, one of the traders who worked, in the same prop shop, I said to some Dalio. Well, Dalio was his idol, in fact, and there was a point where Dalio was auctioning off a lunch, and he actually was, the story's in the book, and if you want me to go into details, I will. Okay. But he bid on that auction to have lunch with Dalio. Anyway, so Arit will, and he will have all his notes on every such trade he's done. He will know what he expects, what he will do if given anything that comes out, what he will do, how the market reacts to what comes out. And then before any important trade, and he will basically focus on these key trades. He may make some other trades, but his bread and butter are these key trades.
Mm-hmm.
And when there's a key event coming up, he will do like breath exercises. He will get very relaxed and focused. He will mentally rehearse everything.
Wow.
So he will know in every circumstance what he's going to do.
Wow.
Just like an athlete might.
Yeah.
Exactly, and that's what I thought when I interviewed him.
Yeah.
It's rehearse the performance, like they're not physically doing it, but in their mind.
Yeah.
And he does that as a trader.
Yeah.
And this is not what he said, but my image of Arit is when there's one of these trades, his universe ends at the borders of the PC. I mean, his entire focus, I mean, like a laser focused on that event.
Wow.
Yeah.
Like a Roger Federer.
So I think he's a Roger Prechter of trading events. Yeah, I mean he's intensely focused, extraordinarily disciplined.
Yeah,
and just incredibly talented.
Fascinating. Thank you. So why, so you've set up this service called Fund Seeder, SEEDER.
Yes.
And one of the things you say about it is that it gives you the analytics that your brokers don't.
Right.
So I've had this question for a long time. Why don't the brokers give you these analytics? Why do they have to be done somewhere else? Are they hard to do, or do the brokers don't want you to see them?
Yeah, maybe that's closer. It's incentives, right?
I think it is, personally, but I wonder what you thought.
Brokers don't want you to give you an equity curve that you can see is going down.
That's my
because you might stop trading, right? So it's not, most people are not successful at trading. So
this is my issue, Jack, is that the whole retail, markets ecosystem business model is based on people performing badly. And, and they draw people in, right? Give them all these tools, encourage them to, now you got Robinhood and they're gamifying the experience. They give confetti when you click a button to do options trades. And the whole business model seems to be premised on how do we make money off of our clients failing.
Yeah, well, no, I don't think that the brokers necessarily
Is that a little too cynical?
No, they would prefer if their clients made money, I think. But that's not the point. The point is that's not their business. Their business is to have the most money on their platform.
Right.
And, not their goal is not, if they can, they're better off, they will try and they're better off if their clients make money. But realistically, they know as a group that that's not going to be the case. Mm-hmm. But they make money by having more money from clients. And
so showing you an equity curve might alert you to the fact that this isn't working out, and you might not put more money into the platform to try to dig yourself out of the hole.
Or you might close your account. You realize, because people rationalize. And I think people may not even realize sometimes when they're losing, how much they're losing. Yeah. But if they physically, so Funseeder, the first page, main page, you see your equity curve. Well, if you're
that has baffled me for the longest time. Like I've started to build software to just track my own equity curve and to do it across multiple accounts and assets, right?
Yeah.
Which I think is really important. So is there anything that we've missed in terms of the laws of success?
Well, it's always a lot. I
liked one tweet I read from you. There was the world always makes sense. So when you think that it doesn't, it's your model of the world that doesn't make sense.
That's Adam Robinson, to give credit where credit is due. Yeah.
And something seeming not to make sense is always a hint of something hidden, something you haven't considered, something exceedingly powerful.
Right. So, and I think those are extremely wise words. What he's basically saying, people are always saying, this market, I'm short. It doesn't make any sense that this market's going up. I'm going to stay short and whatever.
Yep.
And what Adam is saying is, it it makes sense. It's just you don't get understand why it makes sense.
Right.
In retrospect, you'll understand. Of course, it may be too late, but it's dangerous ground to assume that it's something that's happening doesn't make sense. There's a reason why it's happening.
Yeah. So
so
this current rally we're experiencing in the midst of COVID, seeming economic damage, and yet the stock market's hitting all-time highs, and the put-call ratios are at all-time lows, and they just keep going lower, and it doesn't make sense.
And there's potential explanations for it. It doesn't mean that the price is always right, by the way, because things the reason why something is going can in fact be a bubble. Can be because people are now this market is in a type of a bubble thing. I mean, I think it's hard to make sense of Tesla's valuation, right? But it makes sense if people are being influenced by seeing other people make money, and so in some cases that may be the explanation. Doesn't mean that it makes sense in a way that justifies the price, okay?
Right.
But there's always a reason, and it's like I think Robinson. I'm trying to think what his exact phrase was. His definition of a trend is I'm not going to say because I can't remember the exact quote. But his idea is essentially I think his basic, I'm paraphrasing, his idea is that what a trend is really the widening dissemination of an idea. That's what it is. As more and more people realize something, and that's what a trend is. That also ties in, with his philosophy. So let me give you an example. When the 2016 election, okay, the market was pretty pessimistic about if Trump would win, right? So when it seemed surprising, everybody expected Clinton to win, and all of a sudden it looked like it became clear that Trump was going to win, the market started breaking sharply. And then it rallied extremely. And, given all the prior expectation and beliefs, it didn't make sense. Right? It didn't make sense.
Right.
However, what was Trump instrumental in doing ultimately? I mean, forget everything, forget all the politics here, but just in terms of impact on stock market, because I don't want to get into the politics. But what he was instrumental in doing there that impacted the stock market was cutting the corporate tax rate dramatically. Well, what does that do? Well, that kind of boosts profits. It creates a lot of repurchase of companies' own shares, and it's an extremely bullish thing. So it makes sense. Once in hindsight, then it made absolute sense.
Right.
So yes, he was kind of a wild card and could do crazy things, and that was the reason why the market was negative. But this one thing that he did, and I'm not making a value judgment that it's good or bad.
Right.
I'm not talking about that part of it at all. I'm just talking about what is the impact of that. The impact of that was dramatically bullish for the market. So it made sense, right? It made sense ultimately.
Yeah. So do you think that there's anything big that is changing structurally in the world right now that we don't understand?
No, not. I mean, not that I can think. I mean, the biggest change that's going on, and it's reflected. So this is not news. In fact, in some cases, maybe it's over-reflected. But clearly, it is a transition from traditional energy to green energy. That is a trend, that is a powerful trend that is not going to change. I mean, it even went up. Despite nobody could have been more antagonistic to green energy than Trump. And it went on even then, before it became clear that Biden would win. And with Biden there and the rest of the world where it is, that's a powerful trend. So I think if you think about long-term things that are going to be impacting the market, the shift from carbon to green energy it's been there. It's going to get much stronger. And like I say, a lot of stocks discounted or maybe even over discounted it, but it doesn't take away from the fact that this is going to be, one of the really powerful trends that are ongoing.
Mm-hmm.
And, the other trend is also recognized, which is, genetics and, the biology sphere. And, that's another thing which technology is, combined with biology is going to just be one of these long-term things that's not going to change. But of course, this is not new. There are, a lot of stocks have already gone up tremendously on those expectations.
Fantastic. All right, Jack, we have gone over our hour, but it's been fantastic.
It went quickly, yeah.
And I'm really glad we were able to wrap up our 80th anniversary celebration with you because, as one of the books of wisdom in our culture says, in all thy getting, get the understanding. And I think that's what your books bring to the public, and I appreciate it. They've been a big influence on me. I hope you'll keep doing it. I think everybody should get a copy of Unknown Market Wizards. I think you'll find it inspiring that yes, there are the little guys out there who are actually crushing the markets, right?
Yep. Some of them are not so little anymore.
Not so little anymore, yes. And if you're doing great and you want to get on Jack's Fund Seeder platform, you might actually get the attention of some people with capital who'd like you to manage their money. So great stuff, Jack. We really appreciate it. Thanks so much for helping us wrap up.
Thanks,
It's a great
Richard.
week. And we hope to have you back again sometime.
Okay. Well, thank you.
All right. Thank you, everybody. Good night. And it's been a great week. Thank you for all your participation. And please do consider becoming a member of the Foundation for the Study of Cycles if you haven't already. We're a 501c3, $99 a year. Plus make a donation. And we'll keep bringing you all this great content, techniques, and wisdom. And so come back again soon. Thanks.